Bond issuance and amortization are fundamental concepts in the realm of corporate finance and accounting, playing a central role in how organizations secure long-term funding and manage their financial obligations. Understanding these processes requires a deep dive into not only the mechanisms by which bonds are issued, but also the intricate methods used to systematically allocate interest expenses and adjust the carrying value of bonds over time. The journey from the initial decision to issue bonds through to their eventual redemption encompasses a series of carefully regulated steps, each with its own set of accounting principles, legal considerations, and strategic objectives. When a corporation, government, or other entity needs to raise capital for projects, expansion, or refinancing existing debt, it often turns to the bond market as an alternative to traditional bank loans. Bonds, in essence, are debt securities that represent a formal agreement to repay borrowed funds with interest at specified intervals. The process begins with the issuer determining the amount of capital required, the maturity period, and the terms of repayment, including the coupon rate, the fixed or floating interest rate paid to bondholders. These decisions are influenced by market conditions, prevailing interest rates, the issuer's creditworthiness, and the intended use of proceeds. Once the key parameters are established, the issuer collaborates with investment banks or underwriters to structure the bond offering. This involves preparing a prospectus or offering memorandum detailing the terms and risks associated with the bonds. Regulatory approval may be required, especially for public offerings, ensuring that potential investors receive adequate information to make informed decisions. The underwriting process itself can take several forms, ranging from firm commitment, where the underwriter buys the entire issue and resells it to investors, to best efforts, where the underwriter simply acts as an agent in placing the bonds. Pricing the bonds is a critical aspect of issuance. The coupon rate must be attractive enough to entice investors while balancing the issuer's cost of borrowing. If the stated coupon rate aligns with prevailing market rates, the bonds are likely to be issued at par value. However, if the coupon rate is below market rates, the bonds may need to be issued at a discount. And conversely, if the coupon rate exceeds market rates, they may command a premium. The issue price directly affects the issuer's cash inflow and the subsequent accounting treatment of the bonds. On the date of issuance, the issuer receives cash from investors and records a liability on its balance sheet corresponding to the face value of the bonds or the actual cash received, if issued at a discount or premium. The journal entry typically debits cash and credits bonds payable, with any difference between the face value and cash proceeds recorded as either a discount or premium on bonds payable. This initial recognition sets the stage for the ongoing process of amortization, the systematic allocation of the bond discount or premium over the life of the bond. Amortization is essential for matching interest expense with the periods in which the related economic benefits are realized, in accordance with accrual accounting principles. There are two prevalent methods used to amortize bond discounts and premiums: the straight-line method and the effective interest method. The choice between these methods can have significant implications for reported interest expense, net income, and the carrying value of the bonds on the balance sheet. The straight-line method is conceptually straightforward. The total amount of the discount or premium is divided evenly over the bond's life, resulting in a constant annual amortization amount. For example, if a $1,000 bond is issued at a $50,000 discount and has a 10-year term, $5,000 of the discount would be amortized each year. The same logic applies to premiums, which are amortized to reduce interest expense. While simple, the straight-line method is not always accepted under generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. particularly when the results differ materially from those produced by the effective interest method. The effective interest method, on the other hand, is grounded in the concept of time value of money and yields a more accurate reflection of the economic reality of borrowing. Under this approach, the interest expense recognized each period is based on the carrying value of the bonds at the beginning of the period multiplied by the market effective interest rate in effect at issuance. As the carrying value changes due to amortization, so too does the interest expense, resulting in a pattern that mirrors the actual cost of borrowing. When bonds are issued at a discount, the interest expense will exceed the cash interest paid, with the difference representing the amortization of the discount. Conversely, for bonds issued at a premium, the interest expense will be less than the cash interest paid, with the premium amortization reducing the expense. To illustrate, consider a company that issues $1,000 in bonds with a coupon rate of 6% when the market rate is 8%. Investors will only be willing to pay less than the face value, resulting in a discount. The company might receive $920,000 in cash. Each year, the interest expense is calculated by multiplying the carrying value of the bonds by the market rate, 8%. The difference between this calculated interest expense and the actual cash paid to bondholders, $1,000 to 6%, equals $60,000, is recognized as amortization of the discount, which increases the carrying value of the bonds over time. By maturity, the carrying value equals the face value, and the discount is fully amortized. The amortization process is not merely an accounting exercise. It has real-world implications for financial statement users. Investors, creditors, and analysts rely on accurate interest expense figures to assess an entity's profitability, solvency, and risk profile. Overstating or understating interest expense can distort measures such as earnings before interest and taxes, EBIT, net income, and return on assets. Furthermore, the carrying value of bonds impacts key ratios, including debt to equity and times interest earned, which influence perceptions of financial stability and borrowing capacity. Beyond the mechanics of issuance and amortization, entities must also navigate the complexities of bond covenants, regulatory compliance, and disclosure requirements. Bond agreements often include covenants designed to protect the interests of bondholders, such as restrictions on additional borrowing, dividend payments, or asset sales. Failure to comply with these covenants can trigger default, accelerate repayment, or impose penalties, underscoring the importance of diligent financial management. From an issuer's perspective, the decision to issue bonds versus seeking alternative financing hinges on a variety of factors. Bonds offer the advantage of fixed, predictable interest payments, potentially lower costs compared to equity financing, and the ability to tailor terms to suit specific needs. However, they also entail legal obligations, periodic interest payments regardless of profitability, and the risk of refinancing at higher rates upon maturity. The tax deductibility of interest expense can enhance the appeal of debt financing, but excessive leverage increases financial risk and may limit future flexibility. For investors, bonds represent a relatively stable investment, providing regular income and principal repayment at maturity. The credit rating of the issuer, the presence of collateral, and the specific terms of the bond, such as call provisions, convertibility, or sinking funds, affect the risk-return profile. Market interest rate fluctuations can impact the market value of bonds, exposing investors to interest rate risk. In the secondary market, bonds may trade at prices above or below par, reflecting changes in credit risk, liquidity, and macroeconomic conditions. Accounting for bonds does not end with issuance and periodic amortization. Over the life of the bond, issuers may repurchase or retire bonds early, either through open market purchases or by exercising call options. When bonds are retired before maturity, the issuer must recognize any gain or loss on extinguishment, calculated as the difference between the reacquisition price and the carrying value of the bonds. Such transactions require careful accounting and disclosure, as they can significantly impact reported earnings and cash flows. The evolution of accounting standards has brought greater clarity and consistency to the recognition, measurement, and disclosure of bonds and related expenses. Both GAAP and IFRS require transparent reporting of the terms of outstanding debt, the methods used for amortization, and the impact on financial statements. Enhanced disclosure enables stakeholders to better assess an entity's financial health, risk exposure, and management stewardship of resources. Technological advancements have also transformed the landscape of bond issuance and administration. Electronic trading platforms, automated settlement systems, and sophisticated modeling tools streamline the issuance process, facilitate investor access, and improve accuracy in interest and amortization calculations. These innovations reduce operational risk, enhance transparency, and enable issuers to respond more nimbly to market dynamics. In the broader context of capital markets, bond issuance and amortization intersect with monetary policy, fiscal policy, and macroeconomic trends. Central banks influence interest rates, affecting the cost and attractiveness of bond financing. Government bond issuance plays a pivotal role in funding public expenditures and managing national debt, with ripple effects across the entire yield curve. Corporate bond markets reflect investor appetite for risk, economic outlook, and sector-specific developments. The global nature of bond markets introduces additional layers of complexity. Cross-border bond issuance involves currency risk, differing regulatory regimes, and the need to cater to diverse investor bases. Multinational corporations and sovereigns often issue bonds in multiple currencies or jurisdictions, requiring sophisticated hedging and compliance strategies. The rise of green bonds and other thematic instruments reflects growing investor demand for sustainable finance, adding further nuance to the issuance and reporting process. Education and professional development are vital for those involved in bond issuance and amortization. Accountants, financial managers, treasurers, and auditors must stay abreast of evolving standards, best practices, and emerging risks. Certification programs, continuing education, and industry forums provide avenues for knowledge sharing and skill enhancement, fostering a culture of excellence and integrity. Ethical considerations are ever present in the issuance and management of bonds. Transparent communication, fair disclosure, and responsible stewardship of investor funds underpin trust in capital markets. Issuers must avoid misleading statements, aggressive accounting practices, or undue risk-taking that could undermine stakeholder confidence. Regulators play a crucial role in enforcing standards, investigating misconduct, and promoting market integrity. Looking ahead, the landscape of bond issuance and amortization will continue to evolve in response to technological innovation, regulatory change, and shifting investor preferences. The growth of environmental, social, and governance (ESG) investing is driving demand for new types of bonds, such as sustainability-linked and social impact bonds, each with unique reporting and verification requirements. Digital assets and blockchain technology hold the potential to revolutionize issuance, trading, and record-keeping, enhancing efficiency and reducing costs. In conclusion, bond issuance and amortization are multifaceted processes that lie at the heart of modern finance. They enable organizations to access capital, manage risk, and fulfill their strategic objectives, while providing investors with opportunities for income and diversification. Mastery of the underlying principles, meticulous attention to detail, and adherence to ethical and regulatory standards are essential for success in this dynamic field. As markets and technologies evolve, so too must the approaches to issuance, amortization, and reporting, ensuring that the foundational goals of transparency, accountability, and value creation remain paramount. Bond issuance and amortization are not static processes, but rather dynamic activities that interact with various facets of a company's financial strategy and external environment. The decision to issue bonds, for instance, is often part of a broader capital structure optimization effort. Companies weigh the advantages of debt against equity, considering factors like cost of capital, control implications, and the impact on financial ratios. The timing of bond issuance can be influenced by market cycles, interest rate expectations, and anticipated cash flow needs. Savvy treasurers monitor market conditions closely, sometimes preemptively locking in favorable rates through forward contracts or interest rate swaps. The design of a bond offering may include features tailored to the issuer's objectives and investor demand. Callable bonds grant the issuer the right to redeem the bonds before maturity, typically at a premium, providing flexibility to refinance if interest rates decline. Convertible bonds allow investors to exchange their bonds for equity, offering potential upside if the issuer's stock performs well. Zero-coupon bonds, which do not pay periodic interest but are issued at a deep discount, appeal to investors seeking capital appreciation rather than current income. Each of these structures introduces unique considerations for issuance, valuation, and amortization. The accounting for bonds with embedded features is more complex. For example, the proceeds from issuing convertible bonds must be allocated between the liability and equity components, reflecting the value of the conversion option. The amortization of discounts or premiums may be affected by the likelihood of early conversion or redemption. Accounting standards provide guidance on bifurcation and measurement, ensuring that financial statements faithfully represent the substance of the transaction. Interest expense recognition is another area that demands precision. Under the effective interest method, the periodic interest expense reflects both the cash outflow and the amortization of any discount or premium. This approach ensures that the true economic cost of borrowing is recognized in each period, even if cash payments remain constant. The calculation requires careful tracking of the carrying value of the bonds, the applicable interest rate, and the remaining term. Automated accounting systems and specialized software can facilitate these calculations, reducing the risk of errors and enhancing auditability. Tax considerations are integral to the issuance and amortization of bonds. Interest expense is generally deductible for tax purposes, reducing the issuer's taxable income and effective tax rate. However, the tax treatment of bond discounts, premiums, and issuance costs may vary by jurisdiction, with rules governing the timing and amount of allowable deductions. Some countries impose limits on the deductibility of interest, particularly for related party or cross-border debt, to prevent base erosion and profit shifting. Tax planning and compliance are therefore essential components of bond management. Issuance costs, such as underwriter fees, legal expenses, and registration charges, are capitalized and amortized over the life of the bond, further complicating the accounting process. These costs reduce the net proceeds received by the issuer and affect the calculation of the effective interest rate. Disclosure of issuance costs and their amortization is required under accounting standards, providing transparency for investors and regulators. Credit ratings play a pivotal role in the bond issuance process. Rating agencies assess the issuer's creditworthiness, taking into account financial strength, business prospects, and macroeconomic trends. A higher credit rating enables issuers to access capital at lower interest rates, while a downgrade can increase borrowing costs or even restrict market access. Maintaining a strong credit profile requires prudent financial management, timely disclosure, and effective communication with stakeholders. Investor relations are critical throughout the life of the bond. Issuers must provide regular updates on financial performance, compliance with covenants, and material developments. Transparent communication fosters investor confidence, supports secondary market liquidity, and can facilitate future capital raising efforts. In times of stress or market volatility, proactive engagement with bondholders can help mitigate concerns and preserve relationships. Risk management is an ongoing priority for both issuers and investors. Interest rate risk, credit risk, liquidity risk, and operational risk must be identified, measured, and managed. Hedging strategies, such as interest rate swaps, options, or forward rate agreements, can be employed to mitigate exposure to adverse movements in interest rates. Credit enhancements, such as guarantees or insurance, may be used to improve the attractiveness of a bond offering. Robust internal controls and governance frameworks support effective risk management and compliance. The secondary market for bonds provides liquidity and price discovery, enabling investors to buy and sell bonds before maturity. Secondary market prices fluctuate in response to changes in interest rates, credit quality, and market sentiment. Issuers monitor secondary market performance as an indicator of investor confidence and as a benchmark for future issuances. Market makers, dealers, and electronic trading platforms facilitate efficient trading, contributing to overall market stability. The legal and regulatory environment shapes every aspect of bond issuance and amortization. Securities laws, disclosure requirements, and listing rules govern the preparation and dissemination of offering documents. Anti-fraud provisions protect investors from misrepresentation and market manipulation. Regulatory authorities oversee compliance, investigate misconduct, and enforce sanctions where necessary. Cross-border issuances may involve multiple regulatory regimes, requiring careful coordination and legal expertise. Environmental, social, and governance (ESG) considerations are increasingly important in bond markets. Investors are demanding greater transparency around the use of proceeds, environmental impact, and social outcomes. Green bonds, social bonds, and sustainability-linked bonds are structured to finance projects with positive ESG attributes, subject to third-party verification and reporting. The issuance and amortization of these bonds involve additional disclosure and assurance requirements, reflecting the evolving expectations of stakeholders. Financial innovation continues to reshape the bond market landscape. Securitization, for example, enables issuers to pool assets and issue bonds backed by the cash flows from those assets. Asset-backed securities, ABS, mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, offer investors exposure to diversified pools of receivables, loans, or mortgages. The accounting for these instruments involves complex valuation and amortization methodologies, often subject to evolving regulatory scrutiny. Technology is driving greater efficiency and transparency in bond markets. Blockchain-based platforms enable the issuance, trading, and settlement of digital bonds, reducing costs and operational risk. Smart contracts automate interest payments, redemption, and compliance monitoring, enhancing accuracy and reducing the potential for human error. Data analytics and artificial intelligence support credit analysis, risk assessment, and portfolio management, empowering issuers and investors alike. Education and professional development are essential for navigating the complexities of bond issuance and amortization. Universities, professional associations, and industry groups offer courses, certifications, and conferences focused on debt markets, accounting standards, and risk management. Continuous learning is vital to keep pace with regulatory changes, technological advancements, and market developments. Ethical conduct underpins trust in bond markets. Issuers, underwriters, and advisors must adhere to high standards of integrity, transparency, and fairness. Conflicts of interest must be disclosed and managed appropriately. Regulators and industry bodies promote ethical behavior through codes of conduct, enforcement actions, and market surveillance. In summary, the issuance and amortization of bonds are central to the functioning of modern capital markets. They enable organizations to access long-term funding, manage risk, and achieve strategic objectives, while providing investors with stable returns and diversification opportunities. The processes involved are governed by a complex web of accounting standards, legal requirements, and market conventions, demanding expertise, diligence, and adaptability. As markets continue to evolve, driven by innovation, regulation, and changing investor preferences, the principles of transparency, accountability, and value creation will remain at the heart of successful bond issuance and management. The interplay between accounting, finance, regulation, and technology ensures that bond issuance and amortization will remain a dynamic and vital area of practice for years to come. By mastering the underlying concepts and staying attuned to emerging trends, professionals can contribute to the efficient functioning of capital markets, support economic growth, and foster trust among issuers, investors, and the broader community.